All right, good morning. Welcome to Chart Pasta as well. We're going to be focusing on a whole host of stocks in the next half hour. Rod will tell you how to trade the Nifty as well. I'm Nigel D'Souza and joining me is Mangalam Maloo. Well, Mangalam, you're in the studio today. I'm working from home, but it seems this three-day weekend has been good for the bulls. They're re-energized and in fact, they're fighting along, particularly the Nifty Bank.
That's right. You know, the three-day weekend has been good. They've re-energized. The question is, will they get tired through the course of the week and end the week on the weak note or not is the big question, because it is the expiry week. So we'll keep an eye out on that. Painting the screen green right now is Asian Paints, moved to the high point of the day, and UPL as well. The results were good. The company's balance sheet strengthened, and that stock, after an initial dip, has moved to the high point of the day with a gain of almost 4%. But we were talking about expiry, Nigel, you know, and while we've conquered the 90-100 mark, will be extremely important to see whether we go ahead and sustain above 9200 or not, because of a couple of things. One, there is the 20-day moving average over 9200, and secondly, the 9200 call has seen a fair amount of writing. In fact, it's the most active instrument this morning. The 9200 call has added close to around 14 lakh shares just as we speak. The 9100 put as well as the 9000 puts continue to see a fair bit of writing, so we'll keep an eye out on how that pans out. But first up, all the top stories that we're tracking this morning. We start with ITC as the stock gains. The company's entered into the spices business by acquiring Sunrise Foods. This acquisition will give an additional 5 to 7% to the company's FMCG revenue. Reports suggest that this company has been bought for about 2,000 to 2,500 crore rupees, valued just around 4 times sale.
Bharti Airtel low after a large trade. The promoter entity Bharti Telecom sells stake in the company. 3.1% equity shares change hands at an average price of around 570 rupees per share.
Metal stocks, they're higher in trade on positive global cues. Over and above that, we had JSW Steel Management telling CNBC-TV18 that utilization levels have moved to 85%, which compares with 38% last month. JSPL2 has reported good results. The margins expanded on lower raw material costs, increased realizations and lower other costs.
And IDFC First Bank trades higher. The bank reports profit for the first time in the last 7 quarters. The management says 42 to 43% of the loans are under moratorium.
All right, and in weak results, we got some numbers from consumer companies. Revenue for Bata slips over 8% as management says decline is primarily due to the lockdown. For Avenue Supermarts, though, the reported results beat estimates. The commentary for first quarter painted a grim picture.
Okay, all right. Well, as we speak, the Nifty is trading well in the green, as we have been telling you. The good part today is that in the first tick itself, the Nifty went ahead and conquered the 50 DMA. That came at around 9070. So that's pretty good news. Now the next target is holding above the 9200 mark and conquering the 20 DMA on a closing basis. Let's see whether or not that can happen. For the time being, though, let's find out what's the trade on the Nifty and also a couple of trading picks. We have Rahul Mohinder who joins us on the show. Well, morning, Rahul. The bulls will be feeling good today. What do you say is the trade from here? Support levels, resistance levels, and if you're making a fresh trade now?
Well, on the Nifty, I'd still stay away from a fresh trade. My own sense is that around 92.20, 92.30, that's where the big resistance is on the upside, you know, so don't come to bigger conclusions yet. We have to give cognizance to the fact that each time the Nifty went to about 91.50, 91.70, it petered off this last 2 or 3 weeks. So, you know, this is a very, very clear resistance. And even today, you're seeing that after making that high of 91.60 around open, we haven't really been able to, get past those levels or get some traction. In fact, the last 1 hour has just been trickling downwards, in my opinion. So again, I'm not making a fresh trade on the Nifty. I think on the downside, there's still areas where it can move to closer to about 9,000 and then about 8,700. So the targets are still open on the downside. For me, 92.30 is the big resistance I'll watch for.
All right, 92.30 is the big resistance. Rahul, your individual stock calls?
So on the buy side, I'm looking at Wipro and Biocon. On Wipro, we're looking at a buy with a stop loss of 188. And this one could be bought in at current levels for a short-term target of 200. Biocon looks interesting. If you're looking at near-term targets, 365 to 368, that's the area we're looking at. So with a 349 stop loss, one could buy there. On the sell side, this is a bit of an aggressive day trade. Reliance Industries, I'd sell it at the current level of 1430. Keep a stop loss above that 1437, 1440 mark. I'm going to look at targets in the region of about 1405. So these would be the three trades, more on the short-term perspective.
Right. I was just looking at a handful of stocks. Rahul, do you have a view on Eicher Motors? Because remember, the company has informed the exchanges that they are considering a stock split. Interesting move because at higher levels, close to around the 30,000 mark, we did not see any stock split come by. It was one of those high valued stocks. And at 14,000, there is a stock split announced. That's perked up some sort of sentiment. And Eicher Motors has moved to the high point of the day just as we speak, though still negative for the month. Any view on that one?
So very strong resistance on Eicher Motors at 14,950 odd, which is where, all of May we've been kind of struggling to get past that level. But on the whole, I would say if I look at this chart from a slightly longer term perspective, there is significant support. And again, I'm taking a slightly long haul view on this stock. There's significant support at around 12,500 where it kind of bounced up from. So it's kind of made a base for itself. It's been doing some consolidation over the last month or two, with the upper band being closer to that 14,950 level and the lower band, of course, much more towards 12,500, 600 odd levels. So in the main, I think we like the stock if you have a long-term perspective. If you're just trying to trade the short-term move out, then you may do so on the buy side, but keeping a clear stop loss at 13,800.
Fair point, Rahul. Thanks a lot for joining in and giving us all your calls. With that, we simply do a short break. As we do that, we bring you some market opinion coming in from Rajat Rajkaria of Motilal Oswal Financial Services. He says the Indian markets will continue to underperform amidst all its global peers. Listen in.
India is into a phase of significant underperformance. That comes rarely. We have generally seen India always tends to outperform whenever there are any kind of global headwinds. But right now, India is leading its own share of underperformance. Some part of the moratorium will become delinquent. What percentage? I think it is all in the Excel sheet right now. We will have to wait for that. I think the second core problem for financials is that we have not seen an absolute GDP decline in India, at least in my investable career. Right? And financials have always been a big macro play. People started GDP growth with flat to now minus 5%, and we don't know where do we settle. So people generally who do macro trades on financials, they are right now more worried because of the declining GDP. Telecom, the representation into the index is still not properly reflecting the size of the space. If you include Reliance Jio as a part of the telecom weight, then this would be the fourth or the fifth largest sector weight in the portfolio. And that is where it is gaining more traction. But I think, needless to say, people are cutting down financials. People are worried of consumption or discretionary consumption. They are raising their weights on IT, on pharma, on telecom. We are seeing across the board financials cut, consumption cut, rise in telecom, IT, and pharma.
Back, we have the management of Embassy Office Parks REIT on our earnings radar today. Remember, the company reported a good set of results for their fourth quarter. The revenue grew by about 8% on a year-on-year basis. To discuss the results and, more importantly, the road ahead for not just them but the sector as a whole, we have Mike Holland, the CEO of the company, joining us now. Thanks a lot, Mike, for joining in. To get the bookkeeping questions out of the way. The last year you promised close around 18.8 billion rupees in terms of distribution. You went ahead and did that. The year going forward, or the year we are in right now, FY21, what's your target? Do you cross more than 25 rupees per unit?
So I think the number one priority for us has been to deliver on the quarterly distributions. You recollect REIT requires we do that once every 6 months. We're very pleased with the performance in FY20, topping off, I think, at 1882 crores. That's a quarter of $250 million in full year distributions. We're very focused on continuing to deliver to our domestic and international investors in that distribution. But it's not just the quarterly distribution, it's also the increase in the underlying value. And so for the full year, we delivered up 25% total return. We believe from our research that Embassy REIT was the best performing office REIT globally up to 31st of March with that 25% total return. We are moving into an uncertain period. We'll talk about aspects of that later. But of course, our income stream is founded upon those 160 largely international occupiers consistently paying rental through their long leases. So we're in good shape as we go into what will be for everyone a challenging year.
Get that point then, Mike. Give us a couple of details. Everyone's been talking about the moratorium that banks have been giving. What about some of the leases? Have they been paying their rents? What has been the collection, say, in the month of April and the month of May? And do you get the sense that everyone wants to renegotiate the contracts that they've already entered into with regard to rentals?
So, I think the good news for both our occupiers and ourselves was that from the time of the lockdown, we have been able to keep the parks open in accordance with the government requirements, operating for the business continuity of our tenants under essential services. And many of our occupiers chose to operate throughout. As a result, I believe it's linked. We've collected between 92 and 95% of our rentals for April. A number of the parks have now started coming back to full operation. At the end of last week, we had 12,000 people working in the parks and over 120 companies. So I think the collection number, that 92, 95%, reflects the fact that our tenants understand that we deliver on our obligations to provide them with the premises and the overall business environment, and that they are required to stand by their obligations under the lease and continue to pay rentals. And that indeed is what we've seen.
The fact that you've collected around 92 to 95% of rentals is good. However, the street is now worried about any sort of escalations. I mean, okay, you might not have given moratorium or, sort of a longer rope to all the people who've leased your premises, but there won't be any rent escalation, will there be?
Well, I think you have to look at how the rental growth is embedded within the overall portfolio. So the escalations that are there within the leasing contract, we have in the past successfully delivered on those on a 3-yearly basis, increasing between 12 and 15% on those components of rentals. We see no reason that we won't be able to continue to deliver in that space. The portfolio also has what we refer to as the mark-to-market, where our tenants are actually paying over 30, their rental is actually 30% below open market rental. And again, our tenant relationships are long-term relationships. They're 7-year weighted average lease expiries. We see this current phase as something that perhaps over the next 1 or 2 quarters, there will be some pressure on our occupiers. But that mark-to-market we've successfully delivered in the past. We see that coming through in due course. So you have to also recollect that over half of our occupiers are from the technology sector. Over 75% of our tenants are international companies. 42% of them are Fortune 500 companies. And many of these occupiers are precisely the type of occupier that is actually doing well through this distressing period, particularly the technology sector, which is shining globally. And so that gives us a resilience that perhaps is not there for many others.
Okay, all right. So favorable exposure in terms of telecom, technology-based companies, so that's good news. But Mike, I think 50% of your clients are MNCs, multinational companies. Could you give us a brief, in terms of what is the exposure to some of these sectors that have got impacted, like travel, tourism, aviation? Brief numbers?
Yeah, so actually the international component is over 75% of our portfolio. Other major sectors that we cater to would be the banking, financial services sector, engineering, consulting, and so on. In the full 100%, we've assessed that about 6% of our overall rental income is from those sectors which are finding challenges in the current environment. So clearly, anything that's related to hospitality, tourism, and travel, those are sectors that are certainly going to be under stress. Areas in terms of co-working is part of that overall 6%. So, notwithstanding the fact that it is impactful for a small number of companies, for us in our overall portfolio, we're on pretty solid ground.
All right, Mike, thanks a lot for stopping by and detailing your quarterly earnings with us, at the same time telling us that, okay, your long-term tenancies are intact right now, though the street would be a little worried about what happens to the space as a whole, given that technology companies are looking to move their employees into a work-from-home model. But that conversation for another day. With that, we slip into a short break, come back, we talk about a handful of stocks that are doing well. Metal stocks, they're surging in trade today. We'll tell you what's keeping them abuzz.
Well, ITC is holding well in the green. The stock is up close to around 2%. In fact, it's been smoking hot in the last couple of months because the stock is up nearly around 50% or thereabouts. Well, now they're making it even spicier, Mangalam. They're moving into a spicy division. Tell us, run us through the numbers out there.
Indeed, they are moving into a spicy division now. The definition of spicy differs from person to person, because for some people a smoke would be spicy, for some people a hotel room would be spicy, some people eating food would be spicy. But they have acquired Sunrise Foods, and Sunrise Foods is a spice leader in the east of India, and at the same time the consideration is undisclosed, but it's a big positive move for ITC's business. The biggest positive is the fact that it's a high growth segment and it's ancillary to ITC's business. They are into packaged foods and they are into Ashirwad Atta, etc. So that's a positive. It bumps up their FMCG revenue by around 5 to 7%. And as per the reported financials of Sunrise Foods, this business could be margin accretive as well. That's just the reported numbers. Over and above all of that, there could be a whole host of synergies. The first part is ITC's massive agri sourcing capabilities. The second one, they have their hotels, they have their in-house chefs. So, would be easy for the company to find out the perfect blend of spice for the consumers. They are into packaged foods, and over and above all of that, an ITC product is available throughout the country. So this eastern success, can they replicate it across India, would be the big question to find out. In terms of reports, the companies bought this company for around 2,000 to 2,500 crores. That's around 4 times sales. Not bad for a company that has been growing a fair bit. Nigel, on Friday and a couple of days before, we were seeing the stock move on some sort of buzz of a demerger. Instead of a demerger, the company's gone ahead and acquired some companies. So that's about ITC. But metal stocks, they're shining in trade today.
Well, that's right. Risk on helps metal stocks move higher, and you have JSPL as well as JSW Steel. Both of them are moving higher in trade. Now, for JSW Steel, the standalone EBITDA per ton looked much better. It came in at around 8,700 rupees odd, which was much better than the 8,100 rupees we were working with. But that's where the good news ended, because the foreign subsidiaries, they continue to see losses. The EBITDA loss, in fact, is now clocking around 300 crores on a quarterly basis. So that's not good news. And the debt has moved to around 53,000 crores odd. That would mean net debt to EBITDA of around 4.5 times odd. And also they've scaled back their capex from around 16,000 crores to around 9,000 crores odd. But some part of the street, like HSBC, they were expecting them to scale it back to around 7,000 crores odd. But why is the stock trading in the green? One being that they're guiding for sales volumes to be flat in FY21 if you compare it with FY20. That's indicating they're expecting a bit of a recovery in the second half of the year. The second factor was that earlier today we had the management on our channel, and in fact they said that now capacity utilization levels have moved around 85% from around 38% earlier. So that explains why the stock is moving higher. Moving forward to JSPL, then the numbers look good. The margins did expand on a consolidated basis, came at around 25% odd. A few reasons out here. Domestic business did well. The standalone EBITDA per ton came in at roughly around 10,500, 11,000 rupees odd. The absolute number came in at around 1,560 crores odd. There was a growth out there. But pleasant surprise coming in from the power business. Now they clocked around 330 crores in terms of EBITDA, which is a big improvement if you look at it on a year-on-year basis. So good news out there. And their Oman business delivered its best EBITDA all the way since the first quarter of FY19. So a thumbs up coming in for JSPL. Risk on, both these two stocks doing well today.
Risk on indeed, but looks like a bit of a risk off in the market right now. We've slipped a tad bit, still holding at the 9,100 mark for the Nifty, but HDFC Limited and ITC are the two stocks which have moved to the low point of the day. With that, we wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.